Good evening, everybody. Anyways, tonight we've got the great pleasure of having Larry Gaines with us again. Larry is probably one of your best traders that you're going to come across. He's been trading for well over 30 years. He's been teaching people how to generate good income using less risk. And anyways, he's got some very interesting trade strategies for us tonight. So with that, Larry, welcome again to the Candlestick Forum. We're anxious to see your information.
Well, thank you very much for having me here tonight, Stephen. Appreciate everybody being here tonight as well. So yeah, let's get started. So I'm going to be talking to everybody here about a high reward, low risk option trading strategy that's the option butterfly. So it's actually my kind of go-to favorite strategy that I incorporate into my trading. So you're going to find out why tonight. So, one thing that I'd like to start off with is that, trading for yourself is such a rewarding job because number one, we can do it from wherever we want to be, which is such a great thing now. So it's a great way to either supplement your income or, make a living doing it. But you really need to stay educated about what you're trading, and you really have to stay, focused on managing your trading risk. So for me, it's all about directional trading and then managing your risk. And to do that, I like to use options. But, as everybody can probably attest to here tonight as well, it can be very stressful and painful at times. So what I'm going to cover here tonight is a strategy that I love to use for hedging and also for I call offense and defense. So it's, again, what I refer to as the high reward, low risk, low stress option trading strategy, and it's the option butterfly. So yes, I've been actively trading for over 30 years and was previously executive vice president for a company called Transworld Oil, one of the largest oil trading companies in the world, and ran their international trading group for over 10 years out of the beautiful island of Bermuda. So if you ever get a chance to visit Bermuda, make sure you take advantage of it. Beautiful island, beautiful people, really nice people. But lived there for 15 years and ran the group for 10, and just a fantastic experience from a learning standpoint because we traded all the markets, big and crude, but all of the markets as well. And that's where I first, was introduced to options back in the mid-'80s. We started trading options on cargoes of crude oil, so did lots of option trading on oil, and then went on to open up a over-the-counter crude oil options brokerage desk for a company called PVM Oil London. And they're the largest privately owned oil brokerage company in the world, so opened an institutional over-the-counter options desk for them, and just another great learning experience. And that's where I really, got to know what the butterfly spread was all about and how to incorporate it for smaller traders like ourselves, because we were doing a lot of institutional stuff, and they were doing huge butterfly transactions. But these are types of trades that everybody can do. So I'm going to show you here tonight how you can incorporate it to your trading. So the following webinar here tonight is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. Now, what is the best way to profit from options? And in my opinion, and again, it's kind of my go-to strategy, it's the butterfly. And I've learned and I've taught a lot of different trading strategies over the years, but when I thought about what's the most valuable go-to trading strategy that I could, help other traders with, it really came down to the butterfly spread. The huge advantage of the butterfly strategy is its unique framework that allows for more consistent and greater returns due to its simple but very dynamic structure. And because it requires only a small amount of your hard-earned capital, it really helps to, reduce your trading stress because of that lowered capital at risk. Now, unlike other option strategies such as iron condors, credit spreads, or debit spreads, butterflies are very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, you can learn how to trade butterflies, and you're going to be covered for both offense and defense, so goals and protection. And that's the great thing. Now, one of the greatest things about the butterfly spread, the biggest takeaway hopefully you'll get tonight, is it's the best thing that I've found for hedging. And in this kind of market environment, you better be able to hedge and know how to hedge quickly. Now, butterflies can work no matter what the markets are doing. Markets can be going up, they can be going down or sideways. And they're going to help you to provide income from stocks that are going nowhere. They can help to eliminate the stress of trying to pick the direction of stocks or the overall market. They're going to help you to eliminate the time decay expenses that you're going to experience from decaying long options if that's the only game you're playing. And they're going to really help you to take the unsettling guesswork out of your trading. Now, they can also be structured for very little capital at risk, and they can give you 10 to 1 or higher reward to risk positive risk ratios. Those are very common with the butterfly strategy, and you'll see that tonight. Now, butterflies are also very flexible, as you're going to see ahead. And once you learn the basics fundamental setup, then you can adapt it for both your goals and your market insights. Now, the butterfly can also be very good for a delta neutral type trade, but for me, the beauty is that they can be used for directional trading. And in my opinion, trading really comes down to direction and then again managing your risk. But the butterfly, what it can help do for you is it can give you that directional bias by offering you either bullish or bearish exposure to the market when you feel pretty sure of your stock is headed in one way or the other. But if you're wrong, the butterfly is going to help you to manage your risk and at the same time retain a potential for large returns. And that's really a kind of a win-win situation for a trader. But let's be real, the butterfly spread is not going to be the strategy that can offer you that unlimited profit potential, but they're usually going to cost you a lot less than buying outrights and offer you an amazing positive risk reward trade setup. So this means that the butterfly can significantly increase the probability of your winning trades while also at the same time reducing your risk. And that's really what it's all about. You want to have very controlled risk and high winning probability trades. Now here's the great thing. The butterfly can also be used for hedging. So when you mess a trade up, and we're always going to get in a situation where that's going to happen, then you can have the directional butterfly. It can be used to quickly neutralize your risk, lower the risk that you have in a trade, and that's going to help you to cover your you-know-what when your position starts to move against you. So here's the deal. So you can construct a butterfly, say, around a strike that is under pressure from another core trade. So let's say, for example, you had a credit spread on or debit spread and it starts to go against you. Now, this becomes an easy way to immediately, what I call, neutralize the risk, control the risk, and then it can also lower your at-risk amount of capital, so lowering your trading stress. So here's what you can do. Now, let's say you have an original position on and it starts to go against you. So with the butterfly hedge, you can create a butterfly around your original position. Now this hedging strategy, what it does is it takes advantage of time decay, the time decay of an option, while you wait. And many times that's really all you need to do. You'll have a trade that starts to go the right way, you put it on, you feel real comfortable, confident about it, looks great, and then all of a sudden it hits a wall or it loses momentum or it starts to turn against you. And you end up stopping yourself out, and then all of a sudden it goes back in that direction, and you're kicking yourself. What I've found is by incorporating the butterfly around your core trade, by taking advantage of the time decay element, this can help you to buy time, which is a lot of times just all you need. It's just that little bit more time for the original position to stabilize and then move back in your favor. So at that point, you can then just remove the butterfly hedge and stick to your original trade, writing it for all it's worth. So I found this to be the best hedging mechanism or strategy out there. So here's an example. Let's say you had a call debit spread on and you paid $300. So your risk is $300. Now that might that's a defined risk, but still it's $300, or it could be $500, whatever. So you never want to lose your full at risk. So here's a call debit spread structure. So what I found is by converting it to butterfly, you can neutralize that risk. So how do you do that? In this example, all you do is you sell a call credit spread against it. And you do the same width or same width of the spread. So in this example, you're bringing in $200 credit. Okay, so your original debit spread was $300. You just brought in $200. So what happens? You just neutralize that risk and reduced it to $100. So now your max at risk is $100 versus the original at risk of $300. So you've reduced that down, and here's your risk. To the downside, it's only 100. To the upside, but you have this still potentially big profit tent. This is what we call the profit tent. So if it was to go back up here and go out at this particular strike, your target strike, you've got a potential for a huge return on your capital at risk, which you've reduced from 300 down to 100. So that's kind of the basic kind of takeaway of the way to hedge. But let's go through the construction of a butterfly, and you'll get more comfortable with what it can actually do for you. So here's an example of that real famous company, not Alphabet, but XYZ, and it's trading at $45. Now your directional trading model or methodology, and I like to use Fibonacci, it says that the price target, it could go down to 43. So we want to set up a real low risk trade for a directional move to 43. So here's where we can bring in a butterfly. So in this example, what we're going to do is we're going to set up a really narrow, low-risk butterfly strategy for a target down to 43. So we're going to buy a September 42 call, and that's going to cost $2.38. So remember, one option contract is equivalent to 100 shares, so that would be $238. Okay. Now we're going to also buy a 44 call, and that's going to cost $1.06, so 106. Now the butterfly, then we're going to sell two September 43 calls right in the middle of those two strikes, and we're going to get, in this example, $1.67 two times, so 167 times 2. All right, so here's the body of the butterfly, your short strike, and your wings are the long strikes. Okay, so your net debit then is that $2.38 that you paid for the 42 call, plus the $1.06 you paid for the 44 call, less your credit you received from selling two of the 43 calls at $1.67 times 100 to convert it to a spread or an option, and then you can see you're at risk on this example is only $10. Now your profit calculation is you just take the middle strike, so that'd be 43, less your lower strike, 42, so it's a dollar wide spread, minus your net debit, which was 10 cents. And that's going to times 100, that will give you your profit. So in this example, 43 minus 42, so that's a spread of $1 or $100, less your cost of your trade, 10 cents or $10. So that would give you a theoretical profit of 90 cents times 100, so that would be $90. And your risk, though, is only 10, so you can see huge potential reward on your risk. So $90 potential theoretical profit on a risk of 10, gives you a potential $900 return or 9-to-1 positive risk-reward ratio. So that's just kind of a typical example of what we call a balanced butterfly, but there are a lot of other different variations which we'll cover. So the core concept that really makes the butterfly amazing, let's cover that next. And the most important option factor really for options in general and for profit generation, especially the butterfly spread strategy, comes down to understanding the concept of time, theta, and pricing, and their effects on the price of an option. So let's review these core concepts to see how they affect the price of an option. So first off, the main core component for pricing an option comes down to time value, which we also refer to as the extrinsic value of the option. So it's basically the premium that a rational investor would be willing to pay over its current exercise value, known as the intrinsic value, based on its potential to increase in value before expiring. So this probability is always going to be greater than 0, thus an option is always going to be worth more than its current exercise value. And the change in the value of the option based on time decay, we can measure that day to day using the Greek theta. So for example, if you're a buyer and you're buying an option, what you're doing is you're willing to pay a little bit extra for that additional time to let that trade work out. And if you're a seller of an option, you're going to want additional premium because time equals risk. So it's a trade-off there, and you finally meet and put together a price between the buyer and the seller. Now we can measure the time to decay aspect and how it affects the option every day by using that Greek called the theta. Now theta is going to tell us how much an option price will go down over time, which is the rate of time decay of a stock's option. And this is what we can take advantage of with certain option strategies, and the butterfly is one of them. Now, time decay occurs because the extrinsic value, or that time value of the option, goes down as expiration draws near. And the closer you get to expiration, the more that theta kicks in. So you can think of an option kind of like a coupon that you get at a grocery store. If you look at the coupon, you know you have to use it by such certain date, otherwise it expires worthless. And that's exactly how an option is. So with the option theta, you know, using that, we can measure the time decay, and theta values are going to be either positive or they're going to be negative. So all long stock options, such as if you're long a call or you're long a put, that's going to have a negative theta value. So if the price of your underlying is going nowhere, each and every day, that stock option that you're long, it could be a long call or put, it's going to lose value each and every day, and it's going to increase. That theta component is going to increase as you get closer to expiration, and eventually it goes to zero. Now, all stocks that are short, stock options that are short, such as if you're short a call, short a put, will have positive theta decay. So that indicates that if the price is going nowhere, you're still going to benefit from your position. It's going to actually gain value each and every day as expiration draws near. And this is what we're taking advantage of, one of the key pricing components, theta, for the butterfly spread. Now let's go through the pricing of an option, and you'll see how these components affect price. So the main component will be time value. And then the other big component for pricing is implied volatility, and then times the intrinsic extrinsic value, which is the underlying value of your security that you're trading. So once you know these variables, then you're going to be ready to price the option, know what the option premium should be, and then have a better idea of what option strategy you should use. So here's a table to illustrate how these components affect price. So this is a weekly option table or series. So every Thursday, so today we had a new series come out. And on the weeklies, you know, the first day of any option, you have 100% time. So time value times the next component, implied volatility, we're going to move these numbers around some, times the underlying value, which is the intrinsic extrinsic value, equals the underlying, and we're going to keep this at a constant of 1. So you can see how time and implied volatility affect price. Okay, so time value times implied volatility times the underlying equals the premium of the option. So first day, today, let's say, you would have had 100% time. Say the implied volatility was 300 times the underlying, your price of the option would be 300. Now you can see here when you come in on Monday, that time decay element's cut in half. So even if the implied volatility was to spike up on Monday, you can see that it's only going to increase the price of the option, you know, in this example to 400. So 0.50 times 800, implied volatility times the underlying, 400. And so, you know, if you had the implied volatility here of only 300, then your price of your option would only be $150. Now the takeaway here, if you look at this, you can see that time value goes to 0 and implied volatility goes to 0. And this is the beauty of what we're going to take advantage of with the butterfly, is both the time value and implied volatility potentially having that advantage of going to 0. That's where you can really profit. And you can do this also directionally or kind of delta neutral. So the next thing is, well, let's, you know, how do you choose the best butterfly strategy for, you know, your trading goals? And in my opinion, the major goal for every trader really should be to select trades that are based on what's going to provide you the most consistent positive return with very low defined risk and not always the greatest return. And one of the best ways to achieve this is by being aware of the different option strategies and the butterfly strategies primarily that are available, then understanding how they work, and then selecting the one that's best suited for your market environment you're trading in and your specific trading goals. So, you know, everybody here tonight will have a different amount of capital that you can trade, different times of the day you can trade, etc. So you have to take that into consideration of your, you know, kind of your risk profile and the way you want to trade. But there are a number of these strategies that you can use that don't require a whole lot of time, which you're going to see. Now, with the butterfly, there are multiple different types of butterflies, and that's what really kind of makes it a great strategy too, because you've got a different type of unique setup that can be used for different types of trading environment, different types of trade setups. So basically you've got the long call or put butterfly. You've got what we also refer to as the broken wing or skip strike butterfly. It can be done with calls or puts. You've got what I've termed the ninja butterfly or the unbalanced ratio butterfly. This is like my favorite, which you're going to see. And just the directional butterfly, iron butterfly, and then hedging. A big thing here is hedging. It's such a great defensive strategy to use for hedging. Your butterfly spread is perfect for hedging any kind of core option position. So let's take a look at a couple of these different setups, and you're going to get a better idea of how unique this butterfly strategy really is. So the first trade example I want to show you is a butterfly spread on Apple. So these are all directional trade setups, and this first one is an option butterfly on Apple. So in this chart, you're going to see Apple had a big move down, and so what I first look at is a directional trade setup, and then I also incorporate Fibonacci for my targets, and then set up the option strategy I want to use for providing me good leverage plus managing my risk. So I have kind of what I call a 7-step process. But first off, let's look at direction. So Apple in this example, it had this big move up to 156, then it had a huge move down. So we then had Fibonacci levels. We had our 236, 382, 50, and 618. So then the next thing was we were getting a buy signal here. My trading model is based on momentum and what we call a volatility squeeze. So I like to trade these, what I term a volatility squeeze, where the price is coiled and it's going to break either up or down. So in this situation, the dots represent it was in a squeeze. So we were looking for a long trade to the upside. So you can kind of see trend line break here, and so the trade setup was right here on that trend line break. So the next part of the process, okay, is where can it go? So our target for this trade was to the 618, which was $150, and that's a Fibonacci level, 618, plus there was a lot of unusual option activity. So I love to look, and when I see that, that really gives a strong target. Okay, so target was 150. So the next thing is, okay, what kind of strategy or trade setup should we do? So in this one, we did what we call the call butterfly, and this is a skip strike because we skipped one strike on it. So if you look at this setup structure, you can see that this went long the 148 call, short the 150. So $2 wide call debit spread, right? And then we went short the 150 call, short the 152. So that's a $2.50 wide bear call credit spread. You put the two together, and this is a butterfly, but this is what we call the broken wing or skip strike because we had to skip one option strike. In this example, there wasn't $2 strike, so we did the 250. But this is the structure that ended up on the spread. So Apple was trading at 143, and we were looking for that target to 145. So we set up this butterfly, that 148, 150, 152, and it cost only 19 cents, so $19 debit. So if you look at the spread width, so if you look at 148, 142, the spread width was $200 minus your cost of $19. So your theoretical potential profit would be $181 if it was to go out exactly at 150 at expiration. So that would be a 262% return on your at-risk. Your total risk here was 69 because you had to skip this strike here, but your cost is only 19. So that's the difference between a skip strike and a balanced butterfly. But anyway, so what you have here is potential on your at-risk of total at-risk of 69 to make $181 on your risk of 69. So that'd be a 262% return, or 2.6 to 1 reward to risk. Now this actually ended up making $157. So you're never looking to make the full 100%, but if you can make, let's say you can make 40% of 180, 50, 60, 70, you still make a great return on very little cost, very little at risk. So this ended up making 157, which was a 227% return on your total risk of 69, and that was an 825% return though on your cost of 19, which was actually the risk to the downside. So the next thing I'll show you is the risk profile on your analytics. So this is the Thinkorswim platform. So here's Apple, and it's going out right here. You can see at expiration, it's going out on the 21st, right into expiration, like 15, 20 minutes before it was expiring, right almost to 150, almost nailed it perfectly. So it's going out at 149.90. So see, it's at the top of that profit tent. So what's happening is it's squeezing every little bit of time decay that's left, and every little bit of implied volatility is being stripped out. Those are going to zero, right? So that's what really makes the benefit. So we got the direction right based on unusual option activity, Fibonacci, and this went from a 19-cent debit when it was put on to 176-cent debit when it was taken off. So that's $157 per option spread. So that's a 227% return on your total at risk of 69, but it's over an 800% return on your downside risk, which is only 19. So the downside risk here is 19. If this was to scream to the upside, you've got 69. So that's the difference, because there's that skip strike. But that's a huge return, and these are trades that you can put on, and you don't have to stare at the screen all day. You can put it on. You're not too concerned about it because you know exactly what your risk is. So sometimes these are also referred to as a vacation trade. So that's a look there at kind of just your standard butterfly balanced. That one was a skip strike, but very similar to the balance. Now this is my favorite, and it's what I call the ninja, or it's the ratio butterfly. And you can do this either up, for an upside move or downside move. And this is an example on the stock ABBV. So what the unbalanced or ratio butterfly is, it's basically just a variation of that regular equal strike butterfly. But what it does, and this is what's so unique about it, it adds an additional short vertical credit spread to the structure. So basically what it comes down to, it's simply two in-the-money credit spreads protected by a slightly narrower, closer to the money debit spread. So it makes it a very unique kind of structure. So what this creates is a very low defined risk directional option strategy. So the strategy, by doing it this way, you can alter the risk to one direction by either using puts or calls, and then that's going to increase your potential reward. But you're going to notice that your at risk, though, is still very, very low on this type of trade setup. So let's take a look at an example. So this is ABBV, and this is one that we set up last week. Now again, directional trade, everything to me is directional, and then I want to use options as much as I can for the trade. So you can see ABBV. This is some new indicator that I just developed. This is a cycle reversal indicator here. And then these are momentum indicators. So we got a reversal signal here. That was on the 23rd, I believe. And then the 24th, we got momentum signals, and then bought it right there that day after it broke the trend line. So you can see my momentum's up. This is what I call momentum flow, multiple time frames of momentum. And momentum cycle 1, 2 are up, and my reversal indicator right here. So everything looked real good to the upside. And the other thing here, see the dots, it's a volatility squeeze. So this is a chart pattern where you've got a potential for a very, very powerful move up or down. And by momentum, that's how we can determine direction. So we got a buy signal to the upside. So the next thing was, okay, how do we want to trade this? So we did a couple of different trades, actually. One was just doing a call debit spread, but the other one was setting up a put ratio butterfly for that target right there. We were targeting right here the 786 from that high to low, and then this is a 1618 retracement from this high to low here. So we were targeting this area here for the first target 1. So target 1 was 74, target 2 75, and next target's up here at 76.55. But first target was right there, and that's what we structured the trade on, was that target 1. So here's the trade setup, the construction of a ratio put butterfly. So for an upside move, we're going to use puts, because how do you go long an option? Well, you can buy calls or you can sell puts. All right, so you'll see how this works. So in this structure, you'll see it was trading at 72.30. Our target was 74, target 1. So we bought a 75 put, sold the 74. So what is that? A put debit spread, so that's bearish. But then we sold 2 of the 74 puts, bought 2 73. So what is that? That's a bull put credit spread. That's a bullish. And you can see here it's 2 to 1. So we've got a bullish bias, 2 to 1, bull put credit spread to 1, bear debit spread. Okay? So that's what makes it. And you do this as a spread, but you break it down, that's what it looks like. So let's go through the trade setup example. So it was trading at 72.30. We were looking for the first target at 74. Now, this is one thing that's in a volatility squeeze, which has potential for a big, huge move. So this is why I like to use this particular ratio butterfly, because if it does scream straight to the upside, we still can make a good profit. So in this trade example, we actually took some profit today. We received a credit of $61, and that was putting our risk at 39. So you look here, $61 credit. So here's the setup. So this is going long a 75 put, short the 74, and then short 2 74, long 2 73 put. So a bull put credit spread, 2 of those. So 1 by 3 by 2. So that's the ratio. Okay, so 1 debit spread to 2 bull put credit spreads. And you can see it's a dollar wide, 74 minus 70, 75 minus 74. Dollar wide spread, so that's $100, less the credit. So we brought in a credit of 61 that goes straight to your account. So the difference is your risk. In this example, only 39. So you can see very, very low capital at risk. If you get everything wrong, that's the most you would lose, even without making any kind of hedge adjustment or whatever. Now that would give you $161 theoretical profit, which would be a return of over 400% if it was to go out right there at 74. But if it goes straight up and you still get $61, you're still going to have an over 100% return on that capital at risk. So in this example, you've got the advantage is positive theta decay, volatility crush, because volatility, tomorrow's the expiration, it'll go to 0, which makes for a very low capital at risk trade. So today we took partial profit, made $88 per option spread on your risk of 39. So that's a 225% return that was booked today over 6 days. Now, if you just bought ABBV outright and you paid $72.30 and it went to 74, you would have made a 2.4% return on your equity. This, you made a 225% on a risk of only $39 per option contract. So that's the thing that's really outstanding about it. So here's what your profit tent, your risk profile looks like on your analytics. So here you can see it was at 74.06 when this was cashed in. So you can see that purple is the actual end time where it is. The teal is the actual underlying structure. So it was right here today, trading right at 74. And see the difference here? That's still the implied volatility and the theta decay that's left in the option. That's that portion right there. So that's why you're only, on this one, even though it's at 74, you're only making 88 versus the theoretical potential for 161. You're only making 88, which is still really great, but the difference is you still have time decay left, implied volatility in that option. So here you can see it was put on at 61 credit and taken off today. It flipped and went to 27-cent debit. So that's your profit, of 88 per spread, 225% return on your risk of 39. And, on 4 contracts here, that's over $300. Now, tomorrow, if this goes out at 74, though, we can make, 2 times more. We can make up to 160. So we'll see. Got to see, keep some on, see what happens. If we can push into 74 tomorrow, this has more potential. Now, the thing I want to show you here on this example, this is a CRM, a directional trade, but I'm going to show you this beauty of the unbalanced, because you're going to see on a Thursday, day before expiration, this made X, and then just one day later it was trading the same exact price and made 3X, okay, and that's based on the structure. So here's that example, and again, it's a directional trade. So we've got here CRM, and it had traded up to $80. So what you're going to see a lot of times when you're trading, you get these spikes, and then you can see this collapsed, and then it started coming back. It got back over that 618. The first thing they usually do is they go back to that spike, that prior high. So that's what we were looking for. So, you know, this was trading at $78, and you can see we were only looking for a $2 move up. We were only looking for a target to 80, and these are great for really short duration, small, you know, little moves that you're looking for. So the trade setup was a move to the upside based on it, also volatility squeeze. Our directional indicators were all up. So we set up this trade just for a $2 move, and this was doing a put ratio butterfly. So you're going to see her on a Thursday, it was trading at 80. You're going to see what the profit was, and then one day later it was trading at 80, and it made 3 times more money one day later. All right, so the spread setup was, again, a put ratio butterfly. So it's the 81-80 put spread, and then selling 2 bull put credit spreads 80-79. So just $1 wide, so $100 wide spread, less your credit of 52. So your risk then on this trade was 48. Your potential profit then, if you take 81 to 79, that outer wings, that's $200, less your risk of 48, gives you your theoretical potential max profit of 152, which if it was to hit exactly at 80 at expiration, that's potentially what you can make. That'd be over 300% return on that risk of 48. So again, the advantage, positive time decay goes in your favor, volatility crush, very low at risk. So on a Thursday, this day before expiration, took some off at $44 per spread profit, risk of 48, that's a 91% return. But one day later, this is the beauty of it, made 136 per spread, trading at almost the exact same price, which was a 283% return. So 3 times more one day later, trading at the same, basically the same price. So let's take a look here. So here's the profile on Thursday, one day before expiration, and you can see it's trading here at 79.93. So basically, you know, right at 80, right there. But see the difference here? That's that implied volatility and time decay portion in there, okay? So on this one, though, it went from a 52-cent credit, dropped to 8-cent credit. So booked some in, took some partial profit. That's $44 on your risk of 48, 91% return. Now, one day later, Friday, expiration, one day later, look what happens. Up at the top of the tent, okay? And why is that? Because the implied volatility was going to 0, okay? We were trading right here at 80.25, almost exactly the same price. So implied volatility is going to 0. It's a decaying asset. Time decay is going to 0, and it was going out right at our target, so 80. So this then, on one day later, Friday, just one day later, went from a 52 credit to an 84-cent debit, so it totally flipped. And that's your 136 profit versus 44 the day earlier, so 3 times more in a return of 283 on a small amount of risk of 48. So these are, hopefully you can see why I like these types of setups so much. Now here's one more. This is on CMG to show you how you can do this to the downside. So here's an unbalanced ratio butterfly for a short trade setup, and this was on Chipotle. And so on this one, we'll use calls. So we did this entry was on the 4th, and Chipotle was trading right here at 3, you know, like in this area here, 344. And we were looking for a potential target based on Fibonacci down here to this 1272. It had broken everything. It was just getting crushed. So we set up a target right in the middle at 225. So you can see my momentum indicators, everything was down. This was just, you know, looking pretty lousy. So we did a really kind of defined risk trade setup to the downside, doing a call ratio butterfly. So it was trading at 344. Our downside target was that fib level 313. So we set this up for kind of in the middle. So you'll see here we did the 322.5 call, bought that, sold the 325. Okay, so that's a $2.5 wide call debit spread. Then sold 2 of the 325 calls, bought 2 of the 327.5. So that's selling 2 bear call credit spreads. So you can see it's the ratio 2 to 1. So 1 by 3 by 2. So we were more directionally biased to the downside by using the credit spread short. Now this spread, you can see it's a $2.5 wide spread, so $250 the width. We brought in $150 credit. Okay, so $155 credit that goes to your bank account. The difference is your risk, which would be 95. So if everything blew up in your face, you did nothing else to protect it or hedge it or whatever, you would lose a maximum of 95, but very defined risk. Now, if it went out at 325 at expiration on the 18th, you theoretically could make $405, which would be over a 400% return. So you've got these different profit points. You've got either, and if it just screams to the downside, you still would keep your credit 155. So you've got a multiple ranges of profit. So again, your advantage, positive theta, volatility crush, very low capital at risk. So this went out on the 18th. I mean, this thing just cratered down to 313. So this made the max profit it could make was 155 being the credit. So we didn't make the 405, but kept the full credit. So that's 163% return. And if you'd shorted it, you would have made a 9% return on your equity. So here's what it looks like on the profit tent here. So you can see here, this would be, if it went out exactly at 325, it would be here, but it got crushed and went out here at 313. So you kept the full $1.55 credit. So on this, just 2 contracts, that's over $300. But that's why you do the ratio butterfly, because if if it goes past your target in the direction of your trade, you still can keep the credit versus if you did kind of a balanced butterfly. So, there's just a beautiful amount of, technique or advantages to this particular strategy, and there are multiple different ways to use it. And I didn't cover the iron butterfly, but, it's just very, very unique, and again, it's kind of my go-to favorite strategy. So, if you'd like to learn how to master these really high reward, low risk option strategies that work in any market environment, I'm going to show you how you can do it right now. So I've got a really great course for everybody here tonight. I've got it. I like to keep it small enough, so I've got this special set up for 30. If we go over, that's okay. It's special for Stephen, but I like to keep them small enough because I've got some additional bonuses here for you, which I'll show you. But if you could put in that link, it's powercycletrading.com, this /BUY. So just put that link in. You should be able to click on it, and this will give you everything here that you're going to see. So it's an on-demand course that I did, 5 hours, just 100% on the butterfly, okay, all the variations. It's recorded and broken down in 30-minute modules, so this is yours forever, and this is on the cloud, so you can access it from any place. Then you get the training manual, which is the PowerPoint. My courses are very, very detailed. And everything here is $97. So let's go through everything you'll get in the bonuses, and then any questions I'll be happy to take. So in the course, you'll get the 5-hour course, again, on demand, yours forever. Now, if you decide not to buy it tonight, you can go to my website, powercycletrading.com, and you can buy it right there for $297. But I'm going to give everybody here tonight this extra special deal of $97 plus the bonuses. We're going to also then do a live follow-up Q&A. We'll do this probably in 2 weeks to give yourself time to go through the course. So this is something that you get that you would not get in the, if you decided to buy it on my website, which hopefully you won't. So that'll be also part of the bonus. Now, if you can't make it to the Q&A, which is live, it will be recorded. And you could also send in the questions by email if you couldn't make it, and I can answer your question at the first part of the Q&A. The second bonus, you're going to get my option strategy manifesto, which I'll show you in a minute, my Greek power tool guide, which I'll show you, and these are printouts that you can put on your desk. I'm a paper guy, so you can put these on your desk. And then as an added bonus, if you've never been a member to my trading club, I'm going to give you a free trial month to my Power Cycle Trading Club, and I'll show you what's all in that. So again, you get the on-demand course, 30-minute modules, 281-page training manual, and it's an outstanding course. Now, in the course, it's very thorough, so we start off just teaching you what the core basics are that most traders just don't even understand about the butterflies. The butterfly to most traders are just totally confusing, but they're not that difficult as you'll learn in this course. And then what Greeks are important, which are the vital Greeks here and how to use those Greeks. We went through Theta, but you look at the implied volatility and delta and stuff like that. So we covered the basics that you need. It's not a hardcore options masters course, but it's what you need to know. And then how, why, when to use either a long call or put butterfly, that broken wing skip strike butterfly, my favorite ninja ratio butterfly, a broken wing ratio butterfly, directional butterfly, iron butterfly, vacation butterfly. So there are a lot of different variations, and these are all covered in this course. Now, what are the best times then to put these on? Should you put these on 3 days to expiration, 5, 10, 15? So we go through that. How do you get that structure where you can get that 10 to 1 or higher reward to risk on as little as $10? Sometimes you can get it even less than that. So it's an amazing strategy to add to what you're doing currently. But the other big part is the hedging aspect, which I really couldn't get enough coverage on tonight. But we cover a lot of that in the course. And then how to profit, and this is the fun part too, how to profit from that volatility collapse and theta decay. You could see it how you made 3 times more money, and that was because of that volatility collapse and theta collapse to 0 on expiration. Now here's the fun part, how to make big, really great profits, low risk on expiration, option expiration. So on expiration, the markets are trying to find that what we call the pinning strike, where those strikes will settle and go out. So this is a great strategy to incorporate to take advantage of option expiration. So I'll teach in the course how to target those option expiration pinning strikes, profit from them using the butterfly. And then we also in the course will cover the basics that you need for Fibonacci technical analysis to help you set up those price targets that I showed you. So it covers a lot of ground, and it's all thoroughly explained in the course. And then you get the step-by-step checklist of how the butterfly, to put it on, take it off, execution management. And the biggest part of the course, really in my opinion, if you get nothing else, if you never want to use a butterfly, you really need to learn how to use it to hedge. Okay? If you're going to stay in the game of trading, it's all about managing risk, and this is the best, quickest way that you can neutralize and lower your risk. So how to use the butterfly to hedge a core position, how to use it to defend a vertical debit spread going against your credit spread. You'll be just so happy that you learn this that you won't, it'll make a huge difference in your trading performance and your level of stress as a trader. Here's a little feedback as well. So Larry, just wanted to say again, what a terrific job you're doing on the options and tool teaching sessions. You have provided us with such an amazing amount of extremely valuable information and tools, and your ability to teach what you have so cleverly created is simply amazing. So I know I speak for the masses when I say thank you very much for caring about us as students, providing us with great tools and guidance, and for doing such an absolutely terrific job in all that you do. HR, PhD. So I really was very, very thrilled and privileged and honored to get that really nice endorsement. And then here's another one that I just got. It said, Larry, I've been doing the ninja flies, and they are the most incredible way to put option positions on. I've made huge gains on the SPX trades I've done. Thanks for teaching me this option strategy, and I can't wait for your next course, Debbie. So, a little bit of feedback there. So again, just to cover here, you're going to get my step-by-step, I call it my blueprint course, trading options, butterfly spreads for high reward, low risk, 5+ hour on-demand, 30-minute modules, 281-page training manual. You'll get the live follow-up Q&A. It will be recorded. And then you'll get this bonus too, which is my 15 option strategy guide. So 15 of my favorite strategies. So it gives you the risk profile, defines what they are, and you can put this out on your desk, print it out, so you can use it as a quick reference guide for different strategies. And then here's another quick reference guide you can print out. It's my simple and brief option reference guide to the Greeks. So it'll be a good reference guide for what is gamma, theta, delta. You know, you can put that on your desk. And then for everybody here that's never had a membership member to my trading club, you're going to get one free month to check it out. See if you like it. If you do, you get to stay. Hopefully I'll have you stay. And it's $97 a month. But you can start the membership anytime. You don't have to start it after you buy the course here tonight. If you want to start it a month, 2 months from now, just send us an email and we'll start it when you want it. But we have a virtual trading room open each morning at 9:25 a.m. Eastern, and I'm in there first hour, go through all kinds of different trade setups that, you know, it could be a futures intraday trade, it could be a butterfly, it could be a call debit spread, it could be anything. And whatever questions you have, you know, you come in, and then I'm in for the last 45 minutes to kind of go back over trades that we're looking at, setups. I do a daily aftermarket video every night, you know, showing what we're looking at for the markets overall, and then what trade setups we were looking at or coming up to look at. And we do a lot of seasonality type trading setups as well, so go through that if there's anything out there in the video. And then do a live Q&A every week. So if you'd like to come in, ask whatever question, that's every week, and that's also recorded. Got great Traders Educational Vault material for you. And for each month that you're a paying member at $97, you get a $20 credit, and you get 50% discounts on all my courses and trading software. I've got a lot of different trading models and software that I've created. I've been, you know, doing this a long time and created a lot of different trading models. So a lot of stuff that I can offer out to you, but again, you know, to me, directionally, trading comes down to direction and then, you know, managing your risks, and I like to do that through options. So 5-hour on-demand course, live follow-up Q&A, my strategy manifesto, power tool guide, free month, and a lot of good stuff. So hopefully you guys and gals will take advantage of it, and I look forward to working with everybody here in the future. So use that link that hopefully has been provided to you. It's or you can use www. Just type this into your browser, powercycletrading.com, and then that little /BUY, and that should pull up your payment link. So I've got that here. So if you just put that in, you know, whatever browser you're using, just copy and paste that in, powercycletrading.com /BUY, punch enter, and you're going to see that you're only going to see the amazing workshop Butterfly 97. But if you're the first 30, but you know, whoever buys it tonight, I'll give you all the bonuses. I'll just make sure of that. So just put your name, etc., in there, and you can use credit card or PayPal, and that's all there is. So again, if there are any questions, I'd be happy to answer any, or if not, really appreciate everybody taking the time to be here tonight.
Larry, thank you very much. Good stuff.
Thank you, Stephen.
Did you get all the all the questions answered? Looks like it. All right, thank you again, Larry. Everybody,
thank you very much,
take a look
Steve.
at his information. Yep, Larry is kind of an expert in pinpointing what the best trades are for the best option strategies. So with that, thank you everybody for showing up. Larry, thank you. We'll see everybody in the chat rooms.